Risk happens fast. We're seeing it this week. Oh boy, are we seeing it. Lots to talk about the impact of the virus, the fastest move to the downside in history. Yes, this time is different. Buckle up, got a lot to talk about. Let's go. Hello, this is Michael Loftus with Wealth and Wisdom TV, where education is the key to a successful financial future. First up, don't forget, click show more for additional information and links on today's video. Also, if you're looking for a different opinion, that of Wall Street and Big TV, please do consider subscribing because you will see some differences today. Let's get to the agenda. First up, we're going to go through, no surprise, what keeps me up at night. Yikes, a lot going on this week. But still, that macro fundamental data that no one's even talking about. Next, we're going to go to the big charts. Of course, they're not pretty, folks, as one could imagine, okay? From there, we're going to do sector spotlight and game plan going forward. Let's head over to the big board and show you what keeps me up. Risk happens fast, right? No doubt this week. This from The Economist, February 22nd, talking about this bull market with big tech. Boy, that one did not age too well. Next up, is this a black swan event? Thank you from our friends at Hedge, right? And here, if you want some information, it's kind of cut off. It came from a book in 2001. As of right now, yes, this looks like a black swan event affecting all kinds of things, and we will get into that. So I always talk about being different from Wall Street and Big TV. Here's something, peeling back the curtain, showing something I've never shown before. What this shows is commercial net long position, shorts, etc. in the overall market. Now, you may not be able to see some things. The biggest short right now is treasuries. Okay, so like the Bond King and all these people. For us, on the other hand, this has been one of our biggest positions on the bond side. Okay, that's how we're different. And you also look, the Russell, NASDAQ, longs. How about this? Crude oil, 410,000 contracts. That's the big difference. Look, sometimes we were in oil, got out of it quickly. It's not just what you make there. Sometimes you have to sell, okay, to protect, because a lot of these sectors since then have gone into crash territory, which is minus 20%. So I just want to show this real quick. You can stop and look at all the different contracts. I do look at this daily. Okay, reaffirming where we are in the cycles, because this is going to make a big difference, all right? So last year, we go back even to 2018, fourth quarter, we're in cycle 4. Growth was slowing, inflation decelerating, Fed was dovish, markets were deflating, right? We know that. We actually went in the third cycle, okay, in the fourth quarter of 19, and we were projected to be there through this first quarter. Now that changed pretty quickly. When you look at things, we are clearly in the fourth cycle, and I can show you why in a second, but the big thing is we peaked on inflation. So again, we utilize this to determine the asset classes we were in, which has helped us this week as we allocated. No one's talking about this, okay? Yes, this virus is bad. We're going to get into that. But right now, when you look at the earnings pictures, I'm going back to peak, right? When I say we peaked in Q3 18, there it is, right? 24% earnings growth, 12. 0.69 after 480 companies. JOLTS, right? Job openings, all right? Continues to go down. This is what we've been talking about. This was a big move this past month. Openings aren't there, right? What's happening? I'll show you in a second. All right, before I go to the big charts, I'm bringing back something I haven't shown since 18 when we had that pullback. Risk management, okay? It's very difficult, as we know, okay, this week. That first 10% can happen fast. In 2018, it happened over 5 days, okay? And then now we look at what happens with the market and our style. when you're at the bottom, I'm not a bottom feeder. I want to see some confirmations before I start buying into that. Well, the same goes for here. Now, we were positioned well heading into this week. If you've watched my previous videos, you know we've been in bonds and bond proxies and gold, okay? But this move, 10%, was the fastest in history. So don't tell me this time isn't different. The fastest correction in history. Yesterday was the biggest drop in history, and we continue to go down. Let's go to the big charts. All right, starting out, I want to talk about something. Yesterday, I saw these videos on LinkedIn and Twitters with advisors that they're approved broker-dealer speeches. Don't worry, folks. This is part of the markets. We have these, this and that. We do. We have 3, 5, 10% corrections all the time. I agree. But to say that this isn't different is naive, okay? As far as the virus itself, be informed. I have a link right here to a little snippet I did this week about the difference between the flu, which everyone's trying to compare this to the coronavirus. Two very different things, okay? And that's a good reason why you should like us on Facebook, because I put a lot of good stuff out during the week. So, first up, right, we talk about secular bear, secular bulls, okay? As of now, we are still in a long-term secular bull market. This is a correction within that secular bull until we see otherwise, all right? So let's start out on the monthly view. Where are we? Big changes this week, okay? So let's go back to some things that have concerned me and I've constantly have talked about. This is relative strength, okay? When we hit our all-time high here, we had a lot of strength in the market. Each time we hit another high, we had lower highs on relative strength. That is called negative divergence, not good. So when I look at the charts right now, today, meaningful. We have broken below the 12-month, okay, moving average. Right here, okay, is your momentum indicator. Hanging in there by a thread as of today. We look for month end, which is today, and I'll talk about that in a second. So right now, as of this moment, the long term is still positive. Next up, weekly, ugly, okay? I mean, I'm just going to say negative because it's pretty obvious. We have broken through all kinds of support, okay? We've had a turnover of momentum. This has been vicious, okay? Next up, so let's look at the daily chart. Now, here we are. This is live. Holy moly, we're 3.3% already. All right, so let's talk about what's going on here right now. We have broken the 200-day. We have broken the 50-day, okay? Momentum is just crushed, all right? I mean, that is just terrible looking. Let's go down here. This is relative strength, right? Let me delete that. I mean, we're not even, I haven't seen numbers like this before. Normally, when you're below 30 on relative strength, you're considered oversold. But this puppy keeps selling off. So now, there's another thing I want to focus on today. Volatility. Okay, I always talk about this being part of our process. All right, there's a couple things. Very consistent with this story. Okay, here's your volatility index, 10. 10 is, if I go back to, well, look at last year, right? We're below it. 15, when we get to 15 in that range, that's kind of a caution signal. Now, we are at 45 today. Holy schmoly. Now, here's the thing, 30. Kind of missed that one. 31, okay? 31, this market is uninvestable. Do not put money into play until we get below that number, all right? So, that doesn't mean I'm not going to be selling today. I'll talk about that in my game plan, but you have to be careful. Right now, we have not seen this type of volatility before, so it's a time to be very careful, okay? Let's look at some other things real quick. Haven't talked about this because I'm not in these sectors. S&P, haven't been in mid caps, haven't been in emerging markets, but I'm showing you now to tell you how quick things are moving this week. I changed this morning. Here's your S&P. We're going back to 2018. We've given back that much of return. Look at the smalls. I could keep going, right? Mid caps, etc. Across the board, this market is just getting hammered. One of the short snippets I put out this week was about being overbought. This market is too expensive, okay? And I talked about it up here, okay? That's where we were at all-time highs. Now, I want to come up a little bit, okay? Now, as of last week, from January 1st, 2019, we had made 35% in the market. All the while, earnings has grown at 1.92. Crazy. This is what I've been talking about how overbought this market is. So I'm not sure when this is going to end. We're going to talk more about that in a second. And then last but not least, right, here's where we are right now. So I did this a couple weeks ago when we were at our highs. Okay, each of these. Red is 20 PE, which is considered overvalued. 15 is considered fair value, long-term average, and 10 green is undervalue, okay? So at the tops, our first move is going to be here to 25. That would be a 18 and change type move. We're not quite there. Long-term average, 15 on PE, right? Price earnings would take us down to 2,000. That would be a 40% correction. Not saying it's going to happen, but that shows you how overvalued we have been. Last one, lot going on here, okay? Basically, you look for up-down percentages. You have what's called a 90% day. That's a change in the trend, okay? And when you look at that, you might have one day, let me get rid of that. You know, you have a day here, you have a day there, okay? We've had 3 days in a row, unprecedented, across S&P, mids, and small. I mean, this thing is just, it's like a rolling herd of bulls, right? And then it's not stopping, or like that thing they do in Mexico, right? So next thing is, let's talk about the bonds. All right? Huge move.
I'm huge.
Huge. I've been saying this for how long, okay? The bond market's been screaming something for the last 2 months. No one's listening. I was listening, okay? Oh my goodness. We are, okay, all-time lows on the 30-year Treasury. All-time lows on the 10-year Treasury. All time, okay? Again, unprecedented. And because of this volatility, what happens is our risk ranges change. Right now, our risk range on the 10-year is saying 1.15 low. Not saying we're going to hit it, and that number changes every day based on the volume and volatility. The other big thing is yield spreads. 10-year minus 3-month, we're negative. Okay, those are signs for recession. Not going to get into that because I don't see it quite yet. Let's go to sector spotlight and game plan. Okay, first up, one question I've gotten all week. Got it this morning in the gym. What can I do? Well, first off, it's not what can I do, it's what you should have done. Okay? If you've watched our videos, we have been consistent, right? Those cycle 4 assets. Now again, when you're above 31, it's a bloodbath. Everything is selling. They didn't start selling till yesterday, but those moves I made were done a while ago. We started buying gold and treasuries in 2018. Those are the things that help hedge when we have this type of sell-off, okay? So now, what do we do? Well, let me show this and then we'll talk about that. So the dollar was strengthening because we're in cycle 4. We are seeing that change with what's happening. But in cycle 4, what happens is commodities index is crashing. Despite, you saw earlier, 400,000 contract. Wall Street is still long this, right? That is silly. It's just stupid. Okay, so let's talk about the process here. Here's gold. Gold looks wonderful, right? Like I said, we got back in gold some time ago. And what happens is my position will go from 2 to 12% max. okay? Not going to give away all of it, but during this time, right? So here, this is key, right? This is cycle 3, okay? Gold went sideways. That's a time when I'll take some profits, okay? Move to the sideline. And then I add more, okay, as it goes up. In fact, I added more again just on Tuesday of this week. Tuesday or Monday? One day this week, okay? Because we hit an all-time high, we pulled back, and to me, that was an opportunity to add to that position. And that's what we're trying to do right now on assets that are doing well. All right, one more sector, healthcare. As you see, healthcare has gotten destroyed this week. Healthcare generally does well in cycle 4. But we've had a combination of obviously the sell pressure and then also the presidential election. Okay, I'm not going to get into the politics of that, but that has affected things. Now, we happened to trim this position last week, but it's a good sector. It does well, but then you add in other factors, okay, and you have to be careful. So to wrap all this up, bring it at home, okay? As of today, long-term is positive. We'll see. Short-term, mid-term are both negative, okay? What are we doing? Well, I've done a lot already on the first 10% move. Now you look to that next move. This is where we have to be careful. And again, when things are moving so quickly, you have to be careful. But I'll start trimming some equities, raising some cash today. At some point, I'm going to look at the ins and outs and when I think the right time is, and probably add some hedges as we go forward if the market continues to fall. As always, thanks for watching. Michael Loftus, Wealth and Wisdom TV.